recently the leader of the largest bank in the United States, which is JP Morgan Chase, was interviewed by the Wall Street Journal, and he issues a dire warning that we all need to hear. He says, do not get lulled into a false sense of security. And this warning is really important for all of us to hear. So the interview came about because once a year, the CEO of JP Morgan Chase, which is a gentleman by the name of Jamie Dimon, issues a letter to shareholders. And that's why the Wall Street Journal was interviewing him. So let's start with that letter to his shareholders, and then we'll end with the interview from the Wall Street Journal. And be sure to stay to the end, because Jamie's been the CEO for 18 years. He's seen a lot, he's done a lot, and as importantly, he's also taken away some life lessons that we can all learn from. But let's first start with this warning. Okay, so this letter to shareholders is something that's issued every year, and I want to read you one of the quotes. He says, so basically he was saying, the consumer's generally doing okay, but here's what he says. It's important to note that the economy is being fueled by large amounts of government deficit spending and past stimulus. And then he goes on to say, plus there's ongoing wars in Ukraine, in the Middle East. They continue to have the potential to disrupt energy and food markets, migration, military economic relationships, in addition to their dreadful costs on human life. And he goes on to point out, furthermore, there are downside risks to watch. Quantitative tightening, not easing, but tightening. Quantitative tightening is draining more than $900 billion in liquidity from the system annually. So those are the warnings that we need to hear. And Jamie Dimon, getting to this Wall Street Journal interview now, says that to him, it looks a little more like the 70s. And he cautions us, he says, remember that things looked pretty rosy in 1972, but they weren't so rosy in 1973. He also talks a lot about what we all hear a lot in the media, which is this soft landing, right? Hopefully we can avoid a recession, and the Federal Open Markets Committee can glide us in for a soft landing, which I've said in previous videos are really hard to do. And he says he believes that the markets have priced in about a 70% chance of a soft landing, but Jamie Dimon thinks, personally, the odds are about half of that. And he also cautions people that things may not go as well as planned. And I think that's a good caution for all of us. And it's why we do our asset allocation, right? For our savings, whether you've got 20 years to go to retirement or 2 years to go, or you're already in retirement, getting your asset allocation right. What percent of your portfolio is in stocks, which are going to be volatile and go up and down, versus bonds. And personally, I like high quality, short duration bonds that are not going to experience a lot of volatility. I think the purpose of bonds in a portfolio are twofold, but the primary purpose is stability, and followed closely behind by income. But never forget that primary purpose, which is stability, because bonds can be every bit as volatile as stocks depending on the types of bonds that you have. Not only does it matter that they're high quality, but the longer the bond is until it pays you back, the longer the duration, you have what's called duration risk with that. So just be careful. There's a big difference between buying a 2-year treasury and a 30-year treasury bond, right? If interest rates were to go up and stay up, that 30-year bond could take a really big hit, even though the US government issued it, just because you're stuck with, at that point, what could be a lower paying bond. Okay, enough on this. Back to Jamie Dimon's comments in this Wall Street Journal article. He says the consumer is in pretty good shape, but is being propped up by huge government spending. He points to the fact that housing prices are doing well, right? So the consumer's doing well, housing prices are doing well, stock prices are doing well, jobs for the most part are plentiful. But then he cautions, he says the government deficit is about 6% of GDP, gross domestic product, which is the value of all the goods and services that we produce. And he says that's almost $2 trillion, and that is playing a significant role in driving the growth that we're all seeing. His views on inflation, he thinks future inflation could cause other problems, and that inflation may not go away as quickly as people think. And in fact, the soft landing, as I said earlier, may not be as soft as we're all hoping for. And he believes that rates might have to go higher in 2025 or 2026. Big emphasis on might. He's not calling for that. But he does say that future inflation could be a problem. Okay, as far as how the consumer is doing, in this interview, he really says that the consumer is segmented. You know, the folks in the upper half of the U.S. are doing pretty well because the house prices, the stock prices are doing well, jobs are plentiful, etc. But people in the bottom 20% are hurting. And he mentions suicide rates are high, fentanyl addiction, crime, they can't get a home. All of those factors are making it more difficult for the bottom 20% from an economic standpoint. And then he points to the geopolitical threats out there. We've really benefited from a peace dividend for a long, long time. But now the world is rearming and remilitarizing. Obviously, he's talking about the Ukraine war in Israel and Hamas. Okay, now I said I wanted you to stick to the end, and here's why. So that's his warning, and basically he's saying, hey, things may not be as rosy as everybody thinks, and when things correct, they can correct quickly. He uses the example of 1972, where things were looking great, and then a year later, it was a completely different story. So the saying in my industry is the stock market takes the escalator up, but takes the elevator down, right? So things can come down a lot more quickly. So I want you to stay to the end so we can talk about some of Jamie Dimon's life lessons. But let's talk about this part of the interview first. And that is, what should we do based on that? You know, that's why I think, and I mentioned it earlier, our long-term asset allocation is so important. We want to know we can weather the storm in case the stock market starts taking that elevator down. The time to make sure that we have the right asset allocation, I think it's a lot easier to make those adjustments when the stock market's at all-time highs, as opposed to when the stock market's down 20, 30%. And now it's really hard to sell positions because they're down. You have to sell them maybe at a loss. And you're more likely to not just feel the stress of the stock market down, but one of the secrets to succeeding long-term in the stock market is avoiding becoming a forced seller in a down market. And one of the ways many of us, common people, end up being forced sellers in a down market is not just the mental stress, but the anguish, the angst of seeing what you've worked so hard, and maybe you were so close to being able to retire, and then the market drops 20, 30, 40%, and you can't sleep night after night, and it's constantly in the back of your mind worrying about it. You don't want to find yourself in that situation, which is why you want to have an asset allocation that's right for you. This is not financial advice. I do not know your situation, but I do want to encourage you to think about your asset allocation during good times, when you're not under a lot of pressure, when you can think rationally and make great decisions. If we can make great decisions before the anguish happens, we're much more likely to choose a path that makes sense for us. And for many of us, I think working with a financial advisor that's a fiduciary to us 100% of the time makes sense. Okay, enough on that. But the last part of this interview with the Wall Street Journal, to me, as somebody that works with people encouraging them to retire, was really important. And the interviewer asked Jamie Dimon and basically said, hey, you've had a couple scares, some health scares over the last 4 years. He had a cancer diagnosis, and he also had an issue with his heart, where he says, you know, he says when he was being wheeled into the operating room, he knew the odds were about 50-50 whether he was going to survive or not, right? So Jamie Dimon not only has this vantage point on the economy that I wanted to share, but also this vantage point of really doing some soul searching before a risky procedure. And what can we learn from that? And Jamie Dimon said in his moment when he was looking into the darkness and looking at his life and saying, this could be it, he said he did not have any regrets. And I think that's so important. That's when my moment comes. I want to be able to look back and have as few regrets as possible. And oftentimes, there's things in our life that we want to do, but we don't do it because we're concerned. What if we fail? What if the plan doesn't go according to plan, right? All these what ifs. But there's also another what if, which is, what if you don't do it? What if you don't do it? How are you going to feel? Are you going to be okay without doing that? Or are there things that you've been putting off that you really need to do? And yes, as a financial advisor, I want you to save as much as you can. I want you to have as financially secure of a retirement as possible, but I also want you to enjoy the journey, both today and when you're in retirement. So I want you to think about what are those things that, if you were in Mr. Dimon's situation, facing a surgery in a week, facing a surgery tomorrow, sleeping the night before, trying to go to sleep the night before, what are the things you'd be thinking about? Would there be any regrets? And are there things that you could do now, either from an experience, an adventure standpoint, from a relationship standpoint? Are there people that we need to say, I love you? Are there people that we need to ask for their forgiveness? Maybe we did something silly in the past. And so are there things that have been left unsaid that we need to say? Are there adventures? Are there experiences? Are there investments in your life that you'd like to make? And if there are, let's go out and get them. And related to that, thinking about when the right time for you to retire is a super important question. Unfortunately, once we hit 60, most of us are going to have less than 1,000 weeks of healthy active time remaining. And I want you to make the most of each and every one of those weeks, what I call the youth of your senior years. And that's why I made this video up here, 5 reasons to retire as soon as you can. I'll see you in there. Bye-bye.